Hello, everybody. Welcome back to another recording of CISI Level 2 Awarding Fundamentals of Financial Services qualification sessions. This is session 4, connecting savers and borrowers with risk and reward. So this is related to the last part of the second chapter or second element of the qualification called saving and borrowing. Excuse me. So what we are going to look at in this session today is we're going to look at how financial services firms connect savers and borrowers, so those with surplus money with those that need to borrow money, how it connects them via what's known as equities and bonds, which are two different types of financial instruments. We're also going to look at, looked at the last session about who the savers are. We're going to look at a little bit more depth about who the borrowers are, so in respect of companies and governments. And we will also look at the relationship between risk and reward of different types of investments for those that are investing their money into them. So last week we looked at how savers and borrowers were connected by financial services in the form of basically bank deposits and loans. Okay, so how banks connected those with surplus money, the savers, with those that needed to borrow. In this session, we're going to look at how financial services connects, again, the savers with borrowers, but in a slightly different way. And that's via the use of markets, the provision of markets by financial services institutions to enable investors to buy and sell what are known as equities and bonds, which relate to those that want to borrow or raise money. Okay, so we're going to look at how financial services enables these markets to happen for the buyers and sellers, so investors, to buy and sell what are known as equities and bonds. And again, this relates to those that want to raise money, those that potentially want to borrow money as well. So recapping on some of the things that we looked at last week. So last week we focused a lot on who the savers are. Okay, so we looked specifically who the savers were, and we looked at three kind of main types. We looked at individuals, so people like you and I, the general public. We looked at individuals that are quite wealthy, so high net worth individuals. I'm not saying that anybody isn't wealthy that's watching these videos, but we looked at what would be regarded as high net worth individuals. We also spoke about ultra high net worth individuals. So high net worth individuals are those that have assets of $1 million and upwards. Ultra high net worth individuals are those that have assets in the value of $1 billion and upwards. So they are the ultra wealthy, if you like. We also spoke about how savers can be companies. So we looked at, in a previous session, we looked at Apple and how they had a few years back about $142 billion worth of surplus money or cash that they wanted to do something with. So the savers, again, recapping there, those with surplus money that compared with what they actually need. And these individuals or companies need to do something or want to do something with that money. Okay. So last week we focused on those individuals and companies as savers and how they may look to use some of that surplus money. And the way we spoke about last week relates to this top part of the diagram here, which showed how banks acted as the connector between the savers and those that needed to borrow money. Okay, and we spoke more about borrowers in the sense of individuals that maybe needed money, so the general public that needed them. And what banks do, as we spoke about in the last session, is they take deposits, so money placed with them in bank accounts from the savers, and they lend a proportion of that money to borrowers, so to individuals, general public, or to maybe small companies, so small to medium-sized companies. For those that want to borrow that money, the banks take a proportion of the money put into those banks, into accounts with them. They take a proportion of that and they lend it to the individuals or small to medium-sized businesses or companies that want to borrow that money. And if you remember, we said they take only a proportion of the money given to them by savers and lend that, because that then enables them to pay back the savers that want to withdraw their money from those banks. And we called that fractional reserve banking. And we said that banks make money by charging more interest to the borrowers to borrow that money compared with the interest they pay to savers as a reward for placing that money on deposit with them. Okay, so that difference there is how the bank makes a surplus, and then we said all of the costs to run the bank, the operational costs, come out of that surplus to leave them with their profit. Okay, so borrowers can be individuals, the public, general public like us, that don't have the surplus money and need to buy something. It might be a car, might be want to pay for a wedding or whatever that might be, a holiday, whatever that might be, whatever reason they have to borrow that money. They then go to the bank and they connect the savers with surplus cash to them. Okay, and then that enables the borrower to do whatever they need to do, and they pay interest to the bank for lending them that money. So individuals can be borrowers. Small to medium-sized businesses or companies can be borrowers. Also, big PLCs, large listed companies on stock exchanges, the big companies. So your Tesco's, your Sainsbury's, your BT's, your Sky's, British Airways, your Googles, your Apple, all of the big companies. They also borrow money. Okay, so they borrow in a slightly different way to small to medium-sized businesses or companies. So a small to medium-sized business could go to a bank that specializes in loans to companies or to businesses, and they can borrow that money. Large, big companies, large PLCs, large listed companies that have shareholders that list on stock exchanges, they often will want to borrow significant sums of money. We're talking billions, maybe a couple of million, or very large sums of money. Now, they're unlikely to go to a bank or a financial institution to do that. Banks might be unlikely to underwrite that level of borrowing to those sorts of companies. So companies can borrow money, raise capital, as we might say, in a different way. Okay, and companies have two options to them. The large PLCs have two options for them in order to raise that capital. Okay, so it's about raising capital for them, raising money that they then use to expand the business or invest in the business to help it grow and expand. So the two options they have available to them is to issue shares. So if they're not already a public limited company, a listed company, they can issue shares to shareholders. Okay, and we'll talk about what that means in a moment. So they don't borrow it as such. They raise that capital, raise that money through the issue of shares in their company. Okay, now even companies that have already issued shares to shareholders and that are listed on a stock exchange, they can actually issue more shares to shareholders. That's what's known as a rights issue. So even a company that's already issued shares, they can issue more shares to shareholders if they wish to. So if they want to raise additional finance in the future or raise capital in the future, that is an option for them. The other way they can raise money is through borrowing. So they can issue what are known as bonds, and we'll come to those in a moment. They can issue those to investors. So rather than going to a bank to borrow money, they go to investors to borrow money, and they do that through the issue of what are known as bonds. So companies can raise finance or raise capital in a couple of ways, really, through the issue of equities or shares to shareholders, or through borrowing, which is about basically issuing loans to investors rather than going to a bank or a financial services institution. Now, the other borrower that we haven't really spoken about much, we didn't speak about in the last session, is governments. Now, there are some governments around the world in certain countries where they don't need to borrow money because the resources of the country and there's enough wealth there that the government has access to, where they don't need to go out and borrow money. Okay, but for a lot of Western governments, for a lot of governments around the world, they need to borrow money. Governments cannot raise money through the issue of shares, they're not a company, but they can issue bonds to investors rather than going to a bank. Okay, so the reason governments need to borrow money, if we take the kind of UK government as an example, the UK government provides services to the public. Okay, so in order to make those services happen, they have to raise money to do that. Okay, it doesn't just magically appear, they have to go and get the money from somewhere. So the way governments tend to do that, and if we take the UK as an example, is they raise that through taxes. Okay, so they take taxes from people's income, so income tax is generated. So they tax individuals on the salaries they earn and money they earn. They tax people on things like VAT. So when they buy certain goods and services, they charge VAT on that, which is an added tax, an indirect tax. There are numerous ways that the government can raise taxation. Now, in the UK, that's looked after by an agency of the government called HMRC, Her Majesty Revenue and Customs. They look after the collection of those taxes. Those taxes go into the Treasury, which is a government department, and that's where the money is then used to spend on the different areas. They distribute that to the different areas of the government that need to spend on the different projects that they have, or the different services. So we're talking about things like paying for the NHS in the UK, paying for the police force, paying for the military, paying for what else would the government? Lots of things that the government would spend their money on. Okay, and those services are there to help the general public, because maybe the private sector cannot bridge that gap. Okay, now if the level of taxes that the government raises does not equal the amount of money that they need to spend on services, then the government has a deficit there. It has a gap. It has a hole, a little black hole of money that it needs to bridge to be able to afford to pay for those public services. Okay, that is, it has to borrow money, and it does that via bonds. It borrows money. Instead of going to a bank, it goes to investors. Okay, so the government is a big borrower of money. They can't issue shares, as we said, they're not a company. So what they do is they do something similar to what a lot of PLCs, a lot of large companies will do. They issue bonds to investors rather than going to a financial institution. And again, the government borrows large sums of money. Okay, now if you add up all of the amounts that the government has borrowed over the years, take off what they pay back when they service those loans, or they pay money back to bondholders, that's the national debt. So that is how much the UK as a country owes. Okay, so that is basically encompasses the value of bonds that are in issue to borrowers, lenders to investors that the government have issued over time. So focusing on equities and bonds a bit further. So this is obviously very different to deposit accounts and loans that are made by banks. Okay, so when we talk about equities, which is the first thing we'll look at, if you think about the term equity, okay, so we're not talking about equality, we're talking about the term equity. When you use that term, you are talking about ownership. So equities are one way, which is the name of the financial instrument. Equities is one way that a large public limited company can raise capital, raise money, and that's via ownership. And when we talk about ownership, what we mean is a company splits up its ownership into shares. So investors can buy these shares in a company and they become shareholders. They own a proportion or a percentage of a company depending on the number of shares they own. Okay, so financial services firms and institutions, or financial services as a whole through markets, connects The borrowers, which in this case would be companies, large companies that want to borrow money, but instead of borrowing it, what they do is they actually issue shares. So they raise money via splitting up the ownership of that company amongst shareholders. So equities are also known as stocks or shares. So we are talking about part ownership of a company. So technically the company isn't borrowing money. What it is doing is it's selling part ownership of the company to someone that is interested in investing and owning it. Okay. So shareholders are technically part owners of a company. Now, we're talking about large public limited companies. What they do is they issue shares on a stock exchange. So what financial services basically do is they run these markets. So the London Stock Exchange, the New York Stock Exchange, every country has at least one stock exchange where shares in companies there can be sold and purchased. So what they're doing is they are issuing those shares and the shareholders become a part owner. Now, the larger the more shares that a shareholder owns, the larger the proportion of the ownership of that company they have. You will get some shareholders that own the majority of the shares in a company and therefore they have a controlling stake. Now, the debate around whether shareholders really are owners and to what extent they have control over that company is always a subject for debate, because ultimately a large public limited company or a PLC is run and controlled by a board of directors and the chief executive officer that heads that board up. Okay, so shareholders don't always have much control over those companies. In terms of their ownership, a lot of the decisions are made on their behalf by a board of directors and the chief executive officer. Now, private limited companies or LTDs, so not publicly traded, not listed companies on the stock exchange, but limited companies, they will have a much fewer number of shares in issue, and they tend to be owned by the owners of those businesses, so the people that set that company up. Okay. Whereas a PLC might have millions of shareholders that might be located all over the world. Okay, so shares in limited companies, those that are floated on stock exchanges and trade shares on stock exchanges, you can have millions of different owners in that company. Now, shareholders can make financial returns from shares, but the financial returns from shares are not certain. Okay, so shareholders can make money in two ways. They can either make money through something called dividends, or they can make money through something called capital gains. Now, dividends are interesting, and we'll go into more depth about dividends as we go through the qualification content. But dividends are basically a reward paid by the company's board from the company's profits to shareholders, and they are based on mainly profitability of that company in a year. So if the company has done particularly well, the likelihood is that the board of directors will decide to pay dividends to its shareholders. But dividends are not guaranteed, and this is where the lack of certainty comes in. Even if the company does quite well in terms of its profitability, there's no guarantee that shareholders will receive dividends. The board may have other plans for that profit, and they might want to use it elsewhere in the business. Rather than borrow more money, they might decide that they want to take money out of the profits to maybe grow the business, expand it, whatever their strategic aims may be. Okay, so shareholders are not guaranteed dividends every year. Now, that may upset shareholders, and as a result, they may sell their shares. Okay, or people put up with it because they think that actually the longer term view is that it will be positive for the company and will have a positive impact on the share prices and dividends further down the line. So dividends are not certain. They're not always paid to shareholders, okay, which is of advantage to a company and a board of directors. If they want to do something with that money, they are not obliged to pay dividends to them, okay? But you may get unhappy shareholders if a company has done particularly well and therefore they're expecting them. Equally, on the other hand, if a company has a bad year, again, there is not the obligation on the board of directors to pay shareholders on behalf of the company to or pay shareholders dividends. Okay, so if the company is not having a particularly good year, the company doesn't have to pay dividends to those shareholders, which is an advantage if times are tough. The other way that shareholders make money is through what's called capital gains. And capital gains are essentially profit made by a shareholder when they sell their shares for more than what they bought them for. So we're basically talking about profit made by shareholders based on an increase in the value of those shares, so of the asset. Now, capital gains is quite a general term. It doesn't just apply to shares. It often applies to any asset that you sell. If you make profit on it, technically you've made a capital gains. Now, capital gains are taxable. Okay, so if you sell shares for more than what you purchased them for, you may be liable to pay tax on that profit. Okay, that's what's called capital gains tax, and that varies depending on the rate of tax that you pay as an individual, the rate of income tax. Again, capital gains, the profit on those shares is not guaranteed. It is not certain for shareholders. The problem with equities is that share prices, the prices of shares, can be quite volatile. They fluctuate or can fluctuate on a minute-by-minute basis, a second-by-second basis, and a day-by-day basis. So the share price is not guaranteed. It will move up and down over the course of days, hours, months, minutes. Okay, so the certainty of making profit on those shares, there isn't certainty because anything can happen, and lots of things can influence the price of shares, from macroeconomic issues, what's going on politically in a country, interest rates, levels of investment in a country, right down to minute little details for that company. Its profitability, the strategic direction of the managers. If a director has been sacked or voted off of the board, or a new chief exec comes in with a different outlook. It could be environmental issues, lots of different things. So we spoke about VW in a previous session, Volkswagen, and about the diesel emissions scandal. Okay, that was a negative piece of news that has a negative impact on the share price of that company. Okay, as shareholders decide they want to sell them because they don't trust them anymore. So share prices are determined by what individuals are willing to pay for those shares and what investors are willing to sell them for. So share prices are determined basically by supply and demand, what someone is willing to sell them for and what someone is willing to buy them for. So that's why share prices fluctuate constantly, and external factors as well as internal factors within the company can impact on the share price. Okay, so there is not a huge amount of certainty in terms of financial returns for shareholders. Okay, but this is one way that a company can raise capital, raise finance for its plans to develop the company, to grow and strengthen. Okay, now the second way that a company can raise capital or raise finance, and this is also a way that a government can raise money and raise capital, is through bonds. Okay, now bonds are very different to equities. Okay, and if you ever hear the term debt instruments or loan stocks, the other term used to describe bonds are fixed income securities. They are all those terms are referring to what are known as bonds. Okay, now bonds, instead of giving ownership of something, a bond is basically a loan. But instead of going to a bank, either a large PLC or a government will go to investors to borrow money. And again, when we look at bonds in more detail, we'll understand why large companies, large PLCs, listed companies and governments borrow in this way. So rather than going to a financial services institution, a bank, they will go to investors and they will borrow money from them. Okay, so a loan, a bond is a loan made by an investor to a company or government, and the company or government creates these bonds, okay, and then they go out and they sell them to investors and they raise capital and borrow money. So a bond is borrowing rather than splitting up ownership of an organization. I mean, obviously governments cannot, they're not companies that cannot issue shares, but they can issue bonds, as I keep saying. Now, in terms of financial gains for an investor, if they were to buy a bond issued by a PLC or a government, they make money through interest payments. So in the same way that an individual or a small business may go to a bank and borrow money, the bank will charge them interest. The same thing happens with a bond. It's exactly the same principle. An investor that buys those bonds, they are lending money to that company or that government, and in return from that, they will be paid interest in respect of the amount of money that they have lent to that government or company. Now that's what's known, the interest payment is what's known as a coupon. Now the reason that bonds are often known as fixed income securities is that for the majority of bonds, that level of interest does not change for the term of that loan. So each of these bonds has a period of time of which it is live. Okay, so the length of time, the length of maturity that bond has, whether that be 5 years, 10 years, 15 years, 20 years and upwards. Okay, you can get some really, you can get some bonds with some very long lengths of long term, so long maturity dates. So anything with if it's a bond with a maturity or a duration of a year or longer, that's known as a bond. Okay, and there are also financial instruments that I'll talk about in a minute that are debt instruments, so loans like bonds, but have a much shorter period of time over which they have to be repaid. So this is a way that governments and large PLCs can borrow money. So they can raise capital through borrowing, or a large company can raise capital through the issue of shares, so splitting up the ownership of that company. Now, the thing about bonds is they can work in a similar way to shares, in that shares are bought and sold on a stock exchange. Bonds can also be bought and sold on an exchange. So again, the markets are set up so that buyers and sellers of bonds can come together and buy and sell those bonds amongst themselves. And what normally happens is there's normally a sub part of a stock exchange, which instead of giving the ability to trade shares in companies, it gives the ability for investors to trade bonds. But we will go into much more depth about equities and bonds when we look at chapters 4 and 5 of the content of the workbook. So when we look at elements 4 and 5, we will cover off equities and bonds in more detail. Now, equities and bonds are what are known as capital, as a whole, capital market instruments. So that's kind of the umbrella term that's used for equities and bonds. They're known as capital markets instruments. And the reason I've kept saying about raising capital, so equities and bonds are quite long-term ways that companies, and in the case of bonds, governments as well, can raise capital. They raise money that they then need to use to go about offering the services and growing in the terms of a company, and they raise that through issuing shares and issuing bonds. That's what's known as capital markets instruments, or capital markets. It's long-term raising of capital, so raising capital over a longer length of time. Now, I did mention that you can get bonds which have a duration length for less than a year. That they are what are known as money market instruments. So you've got capital markets and you have money markets. The money markets are basically short-term bonds that can be issued by companies, governments, and even specifically banks. Okay, so if a bank, a government, or a PLC wants to raise money in the short term, they can access money markets whereby they create short-term bonds and sell those to investors. So you've got capital markets, and they should be distinguishable from money markets. Capital markets is longer term ways of raising money through the issue of equities and bonds. Money markets is when companies, PLCs, governments, and banks specifically borrow money over a much shorter period of time. So basically a year or less. Okay, so that's generally speaking what equities and bonds are. So this all links into the risk return trade-off, and this is all related to investors. Okay, so what we're talking about here is risk versus reward or return. There's a couple of quotes that have just come up on the slide there. T.S. Eliot, the author, only those who risk going too far can find out how far one can go. And Musa Kent of Coca-Cola mentions where there's no risk, there's no reward. So what we are talking about here when we refer to risk is the possibility of an investor losing their money if they were to invest in a particular financial instrument, okay, or financial asset. So risk is referring to the chance of the investor losing their investment. The reward is talking about the financial return that an investor can make on these financial instruments. Now, what I must stress is what I'm referring to here is not the definitive return. It's not something that is guaranteed, but the potential reward or potential return an investor can make based on the level of risk that they are taking in terms of the chance that they may lose their money. So an investor has to weigh up before they buy financial instruments or buy these investments or sell them even, they have to weigh up the level of risk that they are taking on, so the chance that they may lose their money, and compare that to the level of reward that they would hope to gain as a result of investing their money. Okay, so there's a balance, there's a trade-off there that an investor has to think about. Now, the relationship between them, and again, we've got this chart here, and the activity that we asked you to look at, and we'll come to in a moment, was a list of different financial instruments or ways you might invest your money, where you might put your money as a saver, and the level of risk and reward that would be associated generally with those different methods of using your cash or investing your money. But if we look at this chart, we have on the vertical axis, we have reward, and on the horizontal axis, we have the level of risk. So the higher we go on the vertical axis, the higher the level of reward, and the further to the right that we go on the risk axis, the higher the level of risk associated with that financial instrument. So the relationship with risk and reward is that the higher the level of risk taken by an investor, the higher the potential reward should be for taking that risk. So again, I must stress, it's not the guaranteed amount of financial return that an investor will get, but it has to be the potential to earn that higher level of reward if they are taking a higher level of risk compared with investing their money elsewhere. Okay, so that possibility really has to be given to them. Otherwise, an investor would just turn around and say, well, it's not worth me taking the level of risk for that level of reward, and therefore I won't invest my money there. It also can apply to those lending money. So the higher the risk a lender takes in terms of who they are lending money to, so in other words, the higher the chances that they could lose their money and that they won't get paid back, the higher the rate of interest they should be able to charge to that individual company or government borrowing that money. Okay, so the greater the level of risk in terms of the possibility of not getting their money back, the higher the rate of interest should be for lending that money if you compared it to a safer form of borrowing, so a safer or a less risky borrower. Now, if we go down to the other end of the spectrum, okay, so the opposite will apply. So the lower the level of risk taken by an investor, so the lower the chance that they will lose their money if they invest in that instrument, whatever we're talking about, the lower the potential reward that they should expect. So if they take on less risk, less chance they will lose their money, they are unlikely to get a high reward for that. The lower the level of reward they should expect as a result. The opposite will apply to lending to higher risk individuals. If you're lending to individuals where there is a lower risk or a lower chance that they will not be able to pay you back, okay, so the more creditworthy the borrower is, okay, the less interest or less percentage interest should be charged to that borrower because they are lower risk, so they should be compensated for that. So the higher the risk, the higher the reward or potential reward. The lower the risk, the lower the potential reward. So there is this relationship: higher the risk of the investment to the investor, the higher the reward, the lower the risk, the lower the reward. That's the expectation for an investor. So they have to weigh up the risk reward or risk and return trade-off. Now, we set this task at the end of the last session, and we gave you 6 different ways that someone could different ways that someone could use their savings or put their money somewhere. So you had 8 options: US government bonds, equities issued by a less established company, equities issued by a large, well-established company, bonds issued by a large, well-established company or PLC, bonds issued by a newly listed PLC, cash in the bank, a roulette wheel, or Argentine government bonds. Okay, so what you had to do was place those 8 items on that risk and reward chart where you think the level of risk and the level of reward should sit in comparison to each of those. So if we look at here and we come back to the risk and reward chart here, out of those 8 items or those 8 ways to invest savings, the one that had the lowest level of risk and therefore the lowest level of reward is putting your cash in a bank account. Now, why is that the case? Okay, well, if we take current interest rates that you as an individual could get on putting money in a bank account, you are lucky in the current climate to get anything up to or anything above 0.5%, so 0.5%. The general interest rates you're probably likely to get on a standard bank account is probably about 0.1, 0.2, 0.3%, something like that. The level of return on putting your money in the bank is very low. Okay, so putting cash in the bank does not generate a particularly high return for an investor. So there are a couple of reasons for that. The first is that interest rates are low generally because of, and they have been stereotypically low since the financial crisis, because there's this balancing act in the economy to try and stimulate demand and try and encourage people to put money away. So there's this balancing act going on. You've also got an issue of inflation. And so part of the problem you have with putting your cash in the bank is that if inflation is, say, 1.5%, 2%, but your bank is only paying you 0.3 or 0.2%, your money is decreasing in value constantly because it's not keeping up with the rate of inflation. But the reason why the level of reward is so low is because your cash in a bank is protected. Okay, so it's guaranteed up to the value of £80,000. So the level of risk is low. The chance of you losing your money is low. So if you've got £80,000 or less in your bank account, if anything was going to happen to that bank, you are protected under something called the Financial Services Compensation Scheme. That scheme guarantees that you will get your money back if you have 80,000 or less in the bank if something happens to the bank in which your money is stored and deposited. That's a government-backed protection scheme that basically gives confidence to people that want to put their money in the bank that there's a good chance that they won't lose it. But because of the level of risk is low, the level of reward is also very low. Okay. When if you think about it, if you put your money under the mattress, actually that level of risk is even higher of losing your money. Someone could come in and take it. You could lose some of it. At least if you put your money in a bank, it's stored. Okay, you know where it is. Unless there was fraud carried out, you're not going to lose it. Unless there was some kind of cyber security issue and money was siphoned out of your account, you're not going to lose that money. It's in the bank and it's protected up to £80,000, protected against the bank going out of business, okay, or going under. So the least risky, but also least rewarding, one of those 8 ways you could utilize your savings is cash in the bank. Now, the next, so should we say the next highest risk and highest reward giving is US government bonds. Okay, so US government bonds aren't particularly risky. They are more risky than having your cash in the bank. Okay, but they're not particularly risky, and equally they don't provide you huge rewards. So the interest you'll get on a US government bond won't be staggering, but it will certainly be better than putting your cash in the bank. And the reason why this is less risky for an investor, but more risky than cash in the bank, is that government bonds, especially US government bonds and other kind of well-established economies, the chance that they won't be able to pay that money back to the lender is slim. I'm not aware of the US government ever doing what we call defaulting on their debts. I'm not aware of the US government ever not paying back bondholders. Okay, it's one of the biggest economies in the world. They are reliable. They've got an excellent credit rating. So their credit rating is assessed. It's one of the highest you can get. The chance that the US government won't be able to pay their bonds back is very, very slim indeed. So the level of risk that an investor is taking is not particularly huge. But equally, having said that, the US government could, at some point, default on its bonds if something were to happen negative and there was an issue. Okay. Now, the other reason why a bond is seen as being less risky is because the financial returns are more certain. So especially with a US government bond where the likelihood is that very strong likelihood they will pay it back, you are guaranteed to receive interest that you know it's a set amount, it's fixed, and you know you get that once or twice a year. So there's no uncertainty about, well, there's very little uncertainty about how much you're going to receive and when. It's set in stone. You know how much you're going to get and you know when it's going to be paid to you. So unless something negative happens to the to the US government and they can't pay it back, which again is very slim, the chance of that happening very slim, you know when you're going to get your money back and you know how much you're going to get. Okay, so there's more certainty about the financial returns of a bond. Now, having said that, you will get bonds which offer less certainty and therefore higher risk than others. So a riskier bond than a US government bond would be a bond issued by a large, well-established PLC. Now, obviously, a large, well-established company is a more risky investment than the US government. The US government basically represents the GDP of that country, if you like, because that's where the revenue comes from and where it goes to. A well-established company is obviously smaller than the US, the GDP of the USA. But if they're well-established, they're large, they've been around a long time, the chances that they will default on their debts or not be able to pay their bondholders back will be slim, but it will certainly be a higher risk or more chance of it happening than the US government. So again, bonds issued by large, well-established companies are riskier than those issued by a well-established economy like the US. Okay, so there's less chance there, but it's still fairly low risk. And again, with bonds, you've got this fixed income. You know what financial returns you're going to get and when you're going to get them. The next highest risk will be another bond, but but we're talking here about Argentine or Argentinian government bonds. Now, there's a reason. You might be saying, well, it's another government. Why is this more risky than bonds issued by a large, well-established PLC? Well, the reason is that not all governments are particularly reliable in paying their debts back. So Argentina is an example of a country that since 1816, so since it got its independence from Spain, on 9 occasions between 1816 and 2020, on 9 occasions, they have defaulted on their debt. So they've had to not pay bondholders back. So it's almost like declaring bankruptcy. And there are only 3 other countries where that has happened, where they've defaulted 9 times, and that's Ecuador, Uruguay, and Turkey. Argentina joins that unenviable club. Now, that means that they are much higher risk than US government bonds. And I would argue, or it could be argued, that they are higher risk than a large, well-established PLC. That will depend on who that company is, or what that company is. But certainly, if you've defaulted on your debts 9 times, the chances are that it might happen again. And actually, for Argentina, it happened as recently as 2019. So again, these will be much riskier than US bonds, and arguably more risky than bonds issued by large, well-established PLCs. Now, the riskier the bond, remember, the higher the reward. So what that means, is that Argentine government bonds will need to pay higher rates of interest to the lender, to the investor, than a US government bond, or even a bond issued by a well-established listed company. Okay, and there is actually, in the learning materials on the classroom here, there is an article from Bloomberg that you can read about how Argentine government bonds, or how the Argentinian government, or Argentina as a country, over its period of time, how those 9 defaults have happened and why they've happened. So you can read a bit more about that if you're interested to find out. The next riskiest and rewarding investment would be bonds issued by a newly listed PLC. So if you've got a fairly new, less established listed company, you can argue that they are riskier bonds to buy than even Argentinian government bonds. I mean, if you take the statistic, there used to be a statistic that around 60% of new business ventures fail, especially in the UK. I think that statistic was from the UK. So if you think about that, there's a high rate or high possibility of failure for fairly new, unestablished companies or businesses. That puts newly listed PLCs probably at a higher risk than Argentinian or Argentine government bonds. So again, they would have to offer higher coupons or higher interest rates to investors to compensate for that higher level of risk. The next financial instrument would be equities, so shares that are issued by large, well-established companies. So why are shares riskier than bonds? Well, we've already kind of touched upon this. So obviously you've got the risk that a company may go out of business, but you've equally got that with a bond. If a company goes out of business, then bondholders may not receive their money back. The thing about equities is twofold. There's 2 issues. One is that shareholders will be the last people or individuals that will get their investment money back, so see their money paid back to them if the company goes out of business. Bondholders will be one of the first in the queue because they are owed money by the business. Bondholders will be one of the first in the queue to get their money back, so they're therefore lower risk than shareholders. And equities will be one of the, well, shareholders will be the last people to get their money back if anything happens to the company. The other thing to bear in mind is the certainty of financial returns. So we spoke about earlier, when we spoke about equities and dividends and capital gains, there is no certainty over either of those. So a company, a board of directors may decide that shareholders won't be paid dividends. Okay, they might, the share price can fluctuate and is quite volatile with companies. Share prices can go up and down constantly. So there's no guarantee that a shareholder will make money on its shares if they choose to sell them. So there's much less certainty in terms of the financial returns offered by shares compared with bonds. So that's why, generally speaking, equities, so shares, are riskier than bonds as an investment. Okay. But if we are comparing different types of equities and who they're issued by, certainly shares issued by very well established listed companies are going to be less risky than shares in maybe newly or less established PLCs. So when you're comparing equities to bonds, equities are more risky than bonds. But the other thing you have to bear in mind is that the chances of or the capacity to generate higher rewards also exists with shares. So if you ever look at any articles about investing, people still talk about the fact that you can't, having shares is the best way of investing your money because it potentially has very high rewards. If you invest well, okay, and you buy maybe shares that are undervalued or not discovered yet, hidden gems, you can make a fortune. Okay, so there's the possibility of much higher rewards related to trading equities or owning equities than there are with bonds. But also what comes with that is less certainty that those financial returns will come in, so they're therefore higher risk. The next riskiest and therefore higher reward are equities issued by less established companies. And I think that would make sense when we're thinking about risk levels and potentially reward, because as I said, if you are buying shares in a company that's less well known, less well established, chances are the share price will be lower because people aren't aware of them. They maybe haven't got as good a reputation, or positive things haven't happened to them yet. If you buy at that low price, there's a chance that if they do really well, you could make significant capital gains or even dividends on those shares. And finally, the highest level of risk that you could take would be putting your money on a roulette wheel at a casino, which we are not condoning that you do. That's risky because literally in an instant, you can lose all of your money, either betting on red or black or putting it on a number on the wheel. Okay, so literally you can lose all your money in a case of milliseconds. Okay, so at least with equities and bonds, you may have the chance of redressing some of the losses that you make on equities and bonds. Okay, they don't just disappear. They will always be there unless the company goes under or the bond it gets paid back. So that's there. There's an opportunity to sell them, trade them. With a roulette wheel, you put your money in. If you get it wrong, you lose it all. So it's very, very risky on that front. But equally, you could double your money, okay, in an instant. So again, it could be very high reward, although you often hear about casinos, really kind of the odds are stacked up against you. Okay, so it's already, you go in there and you're destined to lose, okay, ultimately. So it's very high risk, potentially very high reward, not something I would recommend you do with your money. Okay, because what the temptation is that an individual, when they make a loss or when they lose money, they think, oh, I can win it back, and then you end up losing more. So definitely very high risk and not a way that would recommend that you use your money. So that kind of demonstrates the kind of level of risk, level of reward, and why that would be the case, and how that progresses depending on the type of financial instrument you invest your money in, but also who is issuing it. Okay, so what company or what government, who is actually issuing that money, and what protection is there for the investor. So remember, the higher the risk, the higher the reward, the lower the risk, the lower the reward. So for cash in the bank, US government bonds, bond issues issued by large, well-established PLCs, the level of risk will be lower, but therefore so with the potential reward associated with them. Okay, and remember that generally speaking, equities, so shares, are riskier for investors than bonds for two reasons. One is that shareholders will be the last to get paid back if there's any money after a business or a government, or sorry, after a business goes under, or if a business is wound up. And bondholders will be one of the first to get their money back because it's money owed by the company or the government. And also, there is more risk in respect of financial returns. Financial returns are not certain with equities, with bonds. Only if the government or the company defaults on those debts will the bondholder lose their money. But generally speaking, they know when they're going to receive their interest and how much they're going to receive. So there's much more certainty with the returns, financial returns from bonds than there are with equities. So I've kind of summarized a lot of that anyway. What you have to bear in mind is that obviously there are different levels of risk depending on the company issuing these instruments or financial assets. And so, you know, if they're more established or less established, the risk level changes. So you just have to bear that in mind as an investor. And obviously there is more certainty with financial returns for some financial instruments than there are for others. Okay, so that summarizes everything around the saving and borrowing chapter now. So we've looked at deposit accounts and loans and how banks are that kind of intermediary between the savers and borrowers. And we've also there looked at how financial markets enable investors to trade equities and bonds, and how companies and governments can raise capital via capital markets, shares, bonds, equities, and bonds. Okay, so that summarizes everything that we needed to look at the saving and borrowing chapter. Please have a go. There's on the Google Classroom, you will find a multiple choice test on this content that we've just covered off in this session. And look forward to seeing you, or look forward to producing another one of these for you when you come to session 5. Thanks very much.